Today, we shall be talking about the concept of mutual fund. This photo makes it very clear to you what basically a mutual fund is. To begin with, we start with investors. They have their savings. They want to invest it into XYZ, any category. When you have savings, you can invest in land and building so that in future you can reap benefits out of selling it up because the land's value get appreciated. What if your savings are small and you don't have that much money to invest in land and building? So what to do? You can invest in gold and jewelry. Another option is you can even invest in shares. But today we will be talking about investment in mutual funds. So the first stage is the investors who have their little savings and they want to invest in mutual funds. What they do is they pool their money. There will be so many investors. It is not investment on the part of one single person. There will be so many people who will be pooling their wealth, pooling their savings so that it gets a bigger chunk of the saving. And in the case of mutual fund, the investors, they will not be investing themselves. There will be a professionally fund manager who is expert in his profession. And that fund manager, he will collect all the money. The investors will be depositing all the money with this fund manager and he on the behalf of investors, he will be investing in these securities. By securities, here I mean bonds, shares, securities, money market instruments, etc., etc. I will be explaining in the slides to follow. So this fund manager will invest in these securities. These securities will be generating returns. You will be earning profit out of these securities, and this return or the profit, it will be passed back to the investors. So where we started from investors, we are going to end our circle at the investors only. They saved their money, they pooled their money with the fund manager. He invested in the securities on the behalf of investors, and when the returns will start generating, it will be passed on to the investors. So this is a brief picture or a brief story of what a mutual fund is. In this diagram also, we can see that there is the investment on the left hand side from these various A, B, C, D people who have pooled in their investment to a professional manager. He invests in the bonds and thereafter the profit is being transferred to the same people A, B, C and D. So this is the working of the mutual fund. Now, every investor he is going to participate proportionally in the gains or the losses of the fund. Now, if the fund grows and there is a gain in the fund, the gain will be transferred to the investors. What if there is loss? Then this loss also has to be borne by the investors only. This loss will be transferred to the investors. Next question arises, in what proportion? It will be in the same proportion of their investment. If you have invested more, you will be getting more profit. If you have invested less, you will be getting less of the gain. So this is the principle which will be applied in the mutual funds. Larger the investment, larger the profit. All the profit is proportionately being divided amongst all the investors. We get large number of investors in the case of mutual fund, but they have one common objective of earning the profit. They want to grow their wealth. This is their main motive. They come forward, they come together in the mutual fund schemes. It is a financial vehicle that drives your money, that pools the assets from the shareholders. Shareholders here I mean the investors who want to invest in this. They collect the assets, they pool their assets, and then it is channelized into mutual fund, and so is the investment being made. So what word are we using here is a financial vehicle which pool the assets from the general public, from the shareholders to invest in the securities. Again, it is a pool of money. How does this pool happen? Like if there are 50 people in a class and the teacher asks to drop their mobiles in one bucket. So what is it happening? All the mobiles are being pooled up in that bucket, right? Similarly, in the case of mutual fund, it is a pool of money. Every investor will be pooling in, will be putting in his money, and that money which will be collected, it will be managed by a professional fund manager. None of the investors will have say in where to invest. Who is going to decide it? It is the sole decision of the professional fund manager where to put that money in which investment. Mutual fund is also called a trust, which will be collecting money from a number of investors. I repeat, all these investors, they have one common objective: to grow their wealth, to reap the profits. Now this trust, when it will collect money from these investors, it will invest this fund in equities, in bonds, in MMI, money market instruments, and other securities. Now what is the money market instruments? We have made a separate article. You can go through it. Now, the motive is to produce capital gain. This is the real motive of all the investors, and so the professional fund manager also will be trying to invest that money in the securities which will be providing the maximum capital gain, I mean the maximum profit. Now, the income or the gain which will be generated from this collective investment will be distributed amongst the investors, of course, in the proportion to their investment. What will be the ratio? As much they have invested, that much they will gain. What will be deducted from this profit will be the applicable expenses and the levies. Of course, that professional fund manager will be charging a little expense, right? If you go to a professional architect, you have to pay the fees. If you go to a doctor, you have to pay a consultation fee. Similarly, when you consult the mutual fund scheme, they will be asking for a fee for the same. And that fee is called the expense ratio. I have made a separate article on the expense ratio. You can have a look to understand the full and complete meaning of expense ratio. So coming back to this very article, the profit will be distributed amongst all the investors, but this expenses and the levies will be deducted from that profit, and the rest will be credited to the investor's account. So if we talk in very simple terms, the money which is pooled in by a large number of investors is called mutual fund. The fund portfolio is structured and maintained to match the investment objectives stated in the prospectus. You must have heard of a variety of mutual fund schemes, right? So whichever scheme you want to put your money in, you can match that very scheme for your investment, and the prospectus will be underlying the detail as to where and which all securities will the money be put to. Next slide. Mutual fund is very ideal for very good for those investors who either lack large sums for investment. Now, every investor will not be rich enough to have huge bundle of cash, huge bundle of assets to invest in mutual fund. They may be having small savings, small investments. For those particular type of people, for the common man, this mutual fund is very ideal because it gives you a chance to invest with your small savings only, because there will be a pool in of the savings, and that small savings will fund into a big amount. So the people who don't have large sums for investment, mutual fund is the answer to them. Secondly, it is also very suitable for those people who do not have the inclination, do not have the time to research the market. I would also like to add, they do not have much knowledge about the market instruments. For them also, it's a boon. You can just put the money in the mutual fund, and that professional manager will handle your money and give you the return. That's so good. That's so comfortable for those people. So A point is they don't have large sums for investment, and secondly, they don't have the time to research the market, nor do they have knowledge. For them, it's a real boon. But what they want to do is, with their wealth, they want to grow their wealth. They want to earn large and large profits. Now, the small and the individual investors, they get an access to diversified, plenty of options, professionally managed portfolios of equities, bonds, and securities. So otherwise, a small investor may not have an access and knowledge to all these terms, but mutual fund gives them an access to all the diversified portfolios. Each investor will be owning the units. He'll be an owner of a small fund of mutual fund, which represent a portion of the holdings of the fund. Now, the income generated from this collective investment is distributed proportionally, as I've already told you. Next slide. The money collected will be invested by the professional fund managers in accordance with the scheme's stated objective. Now, whichever scheme you want to put for, in that very scheme, your fund will be invested. In return, the fund house will be charging a small fee. It won't be much. It will be just a nominal fee. It is called the expense ratio. And all these expenses, they will be regulated and they are subject to the certain limits which are fixed by the Securities and Exchange Board of India, so that people are not robbed of their money. So SEBI has put the certain restrictions and limitations to how much will the mutual fund be charging for the work. Now, in the mutual fund concept, there's a very important term called the net asset value. Net asset value is the value per unit of a mutual fund. Supposing you are holding 100 units. Okay. If you calculate the value of 1 unit, what will be called? It will be called net asset value in this concept. If I buy a mutual fund, I'll be buying it at the price of NAV. I'll be buying it at the price of net asset value. If I'm going to sell a unit of mutual fund, I will be selling at the price of NAV, at the price of net asset value. Just there is a price of a share. When you purchase a share, you purchase it at a price. Similarly, when you purchase a mutual fund, you purchase it as a price. And what is that price called? It is called NAV. Is it clear? Buy the share at a share price. Buy the mutual fund at NAV. NAV is the measure of performance of an individual scheme of a mutual fund. Very clear from this statement. If a particular scheme is going well, it's doing well, the NAV will be higher. So, what we consider it is a measure of performance. Higher the performance, higher the NAV. It is essentially also called the market value of securities held by the scheme. We determine every security by the market value. If the performance is good, the fund is going good, right? NAV will be more and the market value of securities will be higher. It is the combined market value of the shares, of the bonds and the securities which are held by any fund. I told you the professional fund manager, he will be investing your money in the shares, bonds, money market instruments and other securities. Now, NAV will be representing the combined market value of all these securities on one particular day. It changes on a daily basis. But from this NAV, we will be excluding all the expenses and the charges which will be levied on the fund. You have to deduct these expenses before calculating the NAV. Market value of all units in a mutual fund on a given day, that is called NAV. Net of all expenses and liabilities. So what you have to deduct? You have to deduct all the expenses which will be given to you in the question, and if any liabilities are mentioned, please deduct that also, plus the income accrued. All this data will be given to you. You will be doing all the plus and the minus, but you have to divide it by the number of units because NAV is calculated per unit. This is a very simple term. Class 5 question. Per unit nikalna hai. You will be given the total number and then you calculate the per unit market value. That is to be called the NAV. For example, a mutual fund has issued 10 lakh units of rupees 10 each. At the time of allotment, the NAV is rupees 10 per unit. Luckily, the market value of securities jumped to 200 lakhs. Here, what was the value? It was 100 lakh and now it is, my God, 200 lakhs. So, the NAV per unit will be 20 rupees. How did you get it? 200 lakhs divided by the number of units, which is 10 lakhs. So, it's clearly rupees 20. The current value of the fund will be 200 lakhs, but at the time of allotment, it was 100 lakh. So, this is the meaning of NAV and how will you calculate. It's a very simple procedure. Since the market value of securities, they keep on changing on a daily basis. Similarly, the NAV of a particular fund, it has to change on a daily basis because the market value undergoes a change. Depending on the type of the scheme, it is mandatory and compulsory for the scheme to disclose the NAV either daily or on a weekly basis. Now, this is the formula to calculate NAV per unit, what you will be doing is, in the numerator, total assets minus the total liabilities, and it will be clearly given to you in the question. Just divide them by the number of outstanding units. As simple as it seems to be. Let's take an example. At the close of a trading yesterday, particular mutual fund had this much worth of the securities. This comes out to be 210 lakh rupees. It also possessed 40 lakh as cash and 10 lakh as the liabilities. So what will you doing is, I told you in the previous slide, just keep on adding the value. This is 210 lakhs plus cash, your assets, that is 40 lakhs, and do subtract the liabilities, which is 10 lakh. Okay, divided by the number of units. It's 20 lakhs. So what does the NAV comes out to be? It is rupees 12. Right? A fund's NAV will change daily. Why will it change it? Because the value of fund's securities, cash held, liabilities, number of shares, all these four terms keeps on changing. So the value of NAV will also keep on changing. It has to fluctuate because all these ingredients which are used in this formula will be fluctuating. So obviously this will also be fluctuating. It is a very simple way how to calculate NAV. Now, what determines NAV? NAV of a fund is affected by a set of four factors. To begin with, the first one is purchase and sale of investment securities, which is also called realized profit. I'll give you an example for the same. K Limited, one of the top holding of one of the equity mutual fund schemes. The fund manager had bought the stock at the price of rupees 251.40 per share. Okay, very good. Currently, it is trading at rupees 279.45 per share. So you can see the hike. If the manager sells the stock today, the fund will realize the profit. Of course it will. But if the price declines and it comes out to be 222.05 rupees, the fund manager sells the security at this price. If it does sell it, what will happen? It will result in the loss booked by the fund. If the market value goes up, very good. If it falls and the manager sells the securities, what will happen? It will result in the loss, and which will automatically reflect in the NAV of the fund, which will go down. Right? So my point comes in that the net asset value is affected by the purchase and sale of the investment securities. Next point. It is also affected by the valuation of all investment securities held. In the previous slide, the point was realized profit. And here we will be discussing the unrealized profit. We are just going to value these securities. We are not going to consider the buying and selling. Even if the fund manager does not sell the stock, the up and the down price in the stock will lead to the change in the NAV of the fund, as the fund accounts for the daily closing price of securities to compute its NAV. So even if the fund manager does not sell the securities, he has done no trading, still when you will be valuing your securities which are with you, you may see a clear change, clear fluctuation in the value of NAV, which is called the changes due to unrealized profit. Next point is the other assets and liabilities. Mutual fund invests the entire money collected in various instruments. It can be in the small sized companies in growth funds or in the corporate bonds in the income funds, etc. Sometimes what happens is the liquidity or the volumes in these instruments are very low. At this time, if the fund witnesses large scale redemption pressure from the investors, you know what is redemption? Buyback. What if the investors want their money back and they are asking to redeem their units? What will happen? Now, the fund has to return the money. Sometimes they don't have the liquidity, they don't have that much of cash to repay them. In that scenario, the fund will be borrowing money from banks to satisfy this liquidity requirement due to the large scale redemption. Okay, such liability will come at a cost. The fund has to pay the rate of interest to the bank or XYZ from where the money has been borrowed. Now, this cost will rise, which will affect in the value of NAV. So another point, how the NAV will fluctuate. How and why does the NAV fluctuate? This is the third point related to our question. Last point comes is the units sold or redeemed. Large-scale redemption by the unit holders of the mutual fund may also mean that the fund will have to sell its stocks. It has to get rid of its stocks and it has to sell its securities at the whatever the prevailing prices. You cannot wait for the prices to rise and you cannot wait for the profit to happen. So whatever price is prevailing in the market instantly, because there is the pressure of large scale redemption, stress selling. This is also called stress selling because you don't want to redeem, but still because the investors want it, you have to give their money back. In that case, to satisfy this redemption requests, you have to sell the securities at whatever prevailing prices. All this can further lower the price of the NAV. Clear? Now the NAVs, they have to be disclosed on a daily basis for open-ended schemes as well as for closed-ended schemes. So here we come to the end of the article. I hope I have made the things very clear to you. In case you have any doubts, please feel free to ask me in the comment section. You want to give me a suggestion, feel free to write in the comment section. Please like and subscribe to my channel. Thank you for watching. Stay safe, stay blessed.